Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Good day, everyone, and welcome to another Cambridge podcast. Today we're going to be discussing how do you measure your financial decisions. You know, as I visit with clients every single week, and after having been able to do this for the last 28 years, I do have a tendency to ask a lot of questions. And the reason why I ask a lot of questions when it comes to financial decisions is because I want to be able to understand my clients. I want to be able to understand what makes them tick. I want to be able to understand why it is that they make decision A versus decision B. So I do ask a lot of questions when it comes to those areas of financing. And we're going to be talking about some of the things that are very critical today when it comes to making the right financial decision at the right time. Now, another area of concern that I have with many of my clients is that, you know, the vast majority of decisions that they make pretty much in the micro. And they fail to look at the macro and the impact that those decisions have on the overall financial plan. And what do I mean by that? Well, think of it this way. Individuals, like all of us on this call, we live in the micro, yet the world lives in the macro. And the challenge is that when you make a financial decision on one side of the ledger, it's either going to have a positive or a negative impact on the other side of the ledger. But if you're only making those decisions based on microeconomics and what it is that you're trying to do at that time, then you fail to realize the positives and negatives on the other side of the ledger that would allow you to either make that decision at a much higher level, or perhaps stop making that decision at all, or doing a combination of both. So from that perspective, whenever I do an audit on any of my clients and any of the decisions that they have made in the past, I kind of look at the world through a telescope as opposed to a microscope. And the big question is, well, which is better? Well, there are times in your lives when you're making financial decisions, you look at it from a microscopic standpoint. But before you actually pull the trigger on that decision and implement it, you need to obviously look at it through a telescope, because the views are totally different. In the micro, you're only seeing what's in front of you. In the macro, or the telescopic view, you're actually seeing your entire financial world as it relates to that decision that you have either made or you are about to make. So today I want to talk about a subject that is very familiar for most of us on this podcast. And as you know, we specialize in tax-preferred retirement planning, and we do talk quite a bit about qualified plans and IRAs and stocks and bonds and insurance and annuities and so forth. But today I want to talk about qualified plans. And what I'm going to do is I'm going to take a look at qualified plans, which are your IRAs, your 401ks, your 403bs. If you happen to be a public safety employee, you may have something that is called a DROP, a Deferred Retirement Option Program. So we're going to be looking at contributions and the impact of those vehicles from a micro perspective, and then we're going to look at it from a macro perspective. So the average American, and I would argue that more than 95% of all Americans seldom look at their assets through a telescope. Most of us look at them through a microscope. So if we're making decisions on a 401k, for instance, and we're going to look at it through a microscope, it make all the sense in the world to contribute as much as you possibly can to a 401k as opposed to any other type of retirement vehicle. Why is that? Well, Let's look at it through a microscope. When you're putting money into a 401k, the money that you put in is pre-tax. So you basically have pre-tax contributions. Now, the growth of that money until that time in retirement when you're going to start taking that money out will grow tax deferred. It means that you didn't pay taxes on the contributions, and you're not paying taxes on the growth of that money. And then obviously another critical area is that in the United States, qualified plans and 401ks offer credit protection. So from a business perspective, you're making an investment where the money that you put in is pre-tax, the money grows tax deferred, and obviously it's providing credit protection for you and your family. Now, Leonardo da Vinci, the famous painter, used to say that there were three types of people in the world. Those who see once they're shown, and those who never see. Now, obviously, in my practice, I have met with all three types of people, but I try to work only with people that either see or people that will see once they're educated and they're shown a different direction. So through a microscope, I would argue, that making contributions to a 401k, it's a really, really good idea. Now, what I'm about to say doesn't mean that you shouldn't be putting money into your 401k because, if you're getting a match from your employer, you should be contributing to your 401k up to that match. Anything above that, except for exigent circumstances, there are better places for you to invest your money in. And here's the telescopic view or the macroeconomic view of making those favorable contributions to your 401k when you first looked at them through a microscope. But now we're going to be turning the page and looking at them from a different perspective altogether. Number one, when you look at your 401k through a telescope, you realize a number of things. You have limited access to your funds. And basically that means that if your lifetime is 85 years of age, you're only going to have total flexibility in that plan for 11 years out of those 85 years of your life. That's a major problem because of the opportunity cost that is associated with it. And the reason why you only have 11 out of 85 years of flexibility is that any contributions you make to a 401k, if you decide to take that money, unless you meet certain very strict and exigent circumstances prior to age 59 and a half, you're going to have to pay taxes on the distribution. But most important, you're going to have to pay a penalty, a 10% penalty on what is known as premature distribution. So the government is going to penalize you in your 401k distribution for whatever it is that you want the money for prior to age 59 and a half. In addition to that, you also have the 70 and a half rule, which means that starting at age 70 and a half, you're going to have to start taking money out of your 401k, whether you want to or not. Now, if you're still working as an employee, you may be able to defer that distribution, but once you're retired, whether you need that money or not, you're going to have to start taking distribution out of it. Now, always remember that 401ks didn't come into the marketplace until the early 1980s. Prior to that, the vast majority of Americans were putting their money away either in savings bonds or life insurance. As a matter of fact, only institutional investors, for the most part, are very wealthy individuals, invested in the stock market at all. So investing into a 401k provides you with the penalties of 10% or 50% for certain distributions. So if at age 70 and a half you're supposed to take money out and you fail to do so, then the IRS is going to place another excise tax on you of 50%. Yes, you heard me right, 50%. Now, the other problem that you see with 401ks and that I see with 401ks is that the money grows tax deferred, which is not a bad thing. But when you tax deferred your money, you're also tax deferring your tax liability. And if your money is compounding, the tax liability is compounding as well, and just as fast as your money is compounding. Remember, what belongs to the IRS will always, always, always belong to the IRS. And when you're postponing the tax, you're postponing the tax liability because no one knows where the tax liabilities will be in the future. Well, I can tell you that based on all the studying that I have done over the last 30 years in economics, someone is going to have to pay for the mess that we live in with the $21+ trillion in debt, the $112 trillion in unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the national debt, and interest on the national debt. So, except for the next 8 years under the Trump administration, where we have some taxes that have been reduced and also certain deductions have been increased, everything's going to sunset and go back to the old law in 2025. And then who knows who's going to be in power at that time and what they're going to do with our tax liability. So when you put money away in a 401k, you're deferring that tax liability and you're giving up control of the tax liability to the government. Now, at time of retirement and time of distribution, the government is going to determine how much of your money is going to be theirs. And that's very, very critical. If I came to you and I'm a bank and you wanted a loan and you came to see me and you said, Bert, I would like to borrow $100,000 from you and I want to pay it back. What if I were to say to you, okay, here, I'm going to loan you the $100,000. I'm not going to charge an interest rate at this time. I'm not even certain what kind of an interest rate I'm going to be charging you. But at some point in time in the future, when you come back to the bank and it's time for you to pay me, then at that point in time, depending on banking conditions, economic conditions, how my bank is performing, how I'm performing personally and financially, I am going to determine what kind of an interest rate I'm going to charge you for the money that I loaned you 10, 15, 20 years ago, and it's going to be retroactive to day one. But I'm not going to tell you what the interest rate will be today. Now, how many of you are going to sign on the dotted line and take that $100,000 loan from me? I would argue that none of you would. Yet, this is exactly what we're doing with 401ks because we're allowing the government to make that decision at some point in time in the future, and we have no control whatsoever. And please don't tell me you're going to be at a lower tax bracket in retirement, because unless you've been a financial failure for your entire life, that's never going to happen. Why? Because taxes are going to be greater in the future. And even if taxes were not to increase, there's a high probability that obviously your debt are going to be lower, your deductions are going to be lower, you're not going to be contributing to your qualified plans anymore, you're not going to be making contributions to charitable organizations, your mortgage may be all paid for, so you're not going to take a mortgage deduction. So even if taxes were not to go up in the future, your tax liability may very well be. Now, the other thing that we have to look at through a 401k telescope is the fact that we're losing opportunity cost. And opportunity cost can be applied to either business and or investment opportunities. And the reason why I say that is that because your money, except for only 11 years of your contributions and distributions out of your 401k, it's pretty much in prison, and you cannot access that money unless you have to ask for permission and or pay liabilities and taxes and excise taxes and penalties. Then you're actually having that money in a situation where you can maximize the internal rate of return of the opportunity by shifting some of those monies or some of those savings to other vehicles at a given time that may be producing a higher rate of return for yourself and also for your family along those lines. So again, the money into a 401k, it's pretty much going into jail every single year and will remain there to at least your age 59 and a half. Now, I think we have already talked about the fact that future taxes are going to be higher. Obviously, you can read any publication and take a look at, how it is that we're going to be able to offset the debt. There's only one way that the government generates revenue, and that's by increasing taxes. And we're starting to see on the other side of the aisle, how many conversations are being had that if Democratic Party were to take over, they're definitely going to be raising taxes, for all Americans in the marketplace. Now, obviously, 401k distributions will also have an impact on many other things that you haven't even thought about. See, we all think that when we put money into a 401k, the money grows pre-tax. Then it grows also tax deferred, and then when you pull the money out, you pay taxes on the distribution, and you're good to go. Well, that is the micro look at it. But let's take a look at the negative impact that qualified plan distributions have on the overall macroeconomic view on your finances. 401k distributions will have an impact on your annual taxes. Why? Because whenever you take those distributions out, then you're going to be paying taxes at whatever tax bracket you may find yourself and your family at that time. It will also have a negative impact on capital gain taxes. Capital gains have always enjoyed a much better tax break because of the fact that you are placing your assets at risk, and because you're trying to grow the economy and open businesses and so forth. The IRS does give you the ability to pay a lower capital gains tax than you would in traditional 401ks, which are always taxed at ordinary tax rates. But the fact that you're taking money out of your qualified plans, and depending how much money you take out of your qualified plan, it's going to have a negative impact on your capital gains, because some of your capital gains may actually be brought into the tax liability sooner than expected because of the increase of distribution of your qualified plans. Another major issue, which is a critical one that we do a lot of work with, is the fact that qualified plan distributions like 401ks could very well have a negative impact on your Social Security taxes. Now, as we all know, if 100% of the income that you have in retirement is Social Security benefits, then you would pay no taxes on those benefits. But it is not the income of Social Security benefits that creates the tax liability for you and your family in retirement when it comes to Social Security. It's all the additional income that you may be reporting on an annual basis that will have a negative impact on whether or not your Social Security benefits are going to be taxed at either the 0% tax bracket, the 50% tax bracket, or the 85% tax bracket, or the fact that 85% or 50% or 0% of your Social Security benefits may actually be taxable in retirement. I would say that unless you do proper planning, unless you do provisional income calculation, your Social Security benefits, or up to 85% of your Social Security benefits, will be taxed in retirement. And then, because you decided to take money out of that 401k, either by choice between the ages of 59 and a half and 70 and a half, or by force after the age of 70 and a half, then that's going to have or could have a negative impact on the Medicare premium cost that you would pay in retirement once you reach the age of 65. So very, very few of my clients, if any, have ever thought of the negative impact of those distributions of qualified plans and 401ks do. Now, I deal with a lot of public safety employees because that was my background many, many years ago. And most of them are putting every single dollar that they have on a pre-tax basis. They put money in their deferred comp. They put money into their drop. Their spouses put money away in 401ks and IRAs. And then when they retire, they also have a pension, which is also fully taxable for the most part. And they find themselves actually in a higher tax bracket than before they retired and while they were working. So nobody really thinks through the telescopic impact, the negative impact that taking money out of a qualified plan will have on all the assets that you have coming out to you and the tax liability along those lines. The other issue with qualified plans that you have to also consider is that it does not protect against the risk of dying too soon or living with a disability. Primarily, 401k plans will only try to protect you, and up to a certain extent, against the risk of living too long because, you're putting away money for retirement. So in reality, the dollar that you're putting away into your 401k, it's only serving one purpose. And from an economic perspective, you want to make certain that each dollar that you put away, that it's actually serving multiple purposes. And the more purposes that it serves, the more efficient your dollars are going to be in the future. The other major problem with a 401k, and this applies to everyone, is that there's a lot of stock market volatility exposure. Now, we've been doing fairly well over the last 8 years. We're actually at an 8-year run of a 5-year bull market, because traditionally bull markets are 5 years in length, but we are in year number 8 of a bull market. So we know there's going to be a crash. I just can't tell you when. So the big question for you is, when that crash happens, when your 401k becomes a 201k, are you going to be 5 years away from retirement? Are you going to be 10 years away from retirement? Or are you going to be in retirement? And if you happen to be in retirement, then obviously, Houston, we have a problem, because you can definitely have some major issues and concerns, and you may run out of money before you run out of life. Now, the other thing is that taxes are paid as ordinary income taxes, as I already stated to all of you. There are also financial fees that are associated with qualified plans and 401ks. And there's a double taxation liability when you borrow. Depending on the employer plan, if you have a 401k, you may be able to borrow up to 50% of whatever you have in your 401k, not to exceed $50,000. But you see, what happens is when you borrow, whatever money you borrow out of your 401k, you have to pay back within 5 years. And when you pay that money back within 5 years, you're actually paying that money back into your 401k with after-tax dollars. And then those after-tax dollars go back into your 401k. But then when you retire and you pull that money out again, guess what? You have to pay taxes on those dollars again. So one of the things that I always try to encourage my clients is to make certain that if they need to borrow money for any reason, that they try to avoid as much as possible taking money out of their qualified plans. So when you look at contributions to a 401k, and you actually look at it from a microeconomic perspective, or you look at it through a microscope, you may think that you are in fact making the right decision for yourself and your family. Once you start making a paradigm shift and you start to take a look at those contributions and the growth of that 401k through a telescope and through a macroeconomic perspective, then you start to see the negative impact that those micro decisions that you made years ago by putting money into a qualified plan are now coming back in a negative way through a telescopic view, because it has a negative impact on the other side of the ledger, which is the distribution side of the ledger. Now, by no means, as I stated at the very beginning, do I tell you that you should not be making contributions to a qualified plan, because at times it would be a good idea to do so. But you have to be very careful. You have to be able to work with someone who's a retirement strategist, someone that specializes in tax planning like we do at Cambridge, that is not only going to help you determine how much should you be contributing to a qualified plan every single year. It will also help you determine what is the most amount of money based on provisional income calculations that you should have in your 401k. And then ultimately is going to help you determine what to do with the rest of your savings in order to maximize the internal rate of return for yourself, your family, and your business in the future. And by the way, if you do proper provisional income calculation planning, which the vast majority of financial advisors in the United States do not understand and have never heard of, you might be able to get away with murder. And what do I mean by that? Well, you might be able to, just if you do it the right way, and you have 10 years away from retirement, you may very well be able to put the money away pre-tax, have the money grow tax deferred, and then at time of distribution, you pull the money out tax free. Now, if you're able to do those things in that order, then you have a win-win-win for you and your family along those lines. Again, I thought it would be a good idea for us to have a conversation today in making a determination and hoping getting all of you to start shifting and start looking at your life through a different paradigm shift, and to look at your financial decisions through a telescope as opposed to a microscope. And as always, my job and that of my firm is to help you change in the way that you see things. Because when you do change in the way that you see things, like in this particular case, the things that you see start to change. Now, next week, I'm going to take another one of those products that are so critical for your retirement benefits, and we're going to go through the same exercise. We're going to look at the pros of making contributions through the micro, and then we're going to look at the pros and the cons of contributions and distributions through the macro, and looking at them through a telescope as opposed to a microscope. So again, thank you so very much today for giving me a few minutes of your time, and we'll talk again next week.